This is for two notes. We're going to be talking about uh, breaking down their financial statements a little bit by department, filling out a margin statement, doing indirect, direct deposits or expenses, excuse me. And we used to call them component percentages. Now they're ratios, very similar stuff. If you recall, when we did financial statements, a lot of this from last semester hopefully will come in. It's the end of this counting cycle again. Um, and basically, what we're talking about when we're doing this is managers want to take this um, responsibility, of running their department seriously by being able to have all the information possible. Okay. So instead of the shield store trying to make decisions based on total numbers, they're making it based on departments. And so that's what they're talking about in this. We want to make sure that each department advertising, the labor costs, revenues, expenses, all this is done by departments. Um, and so that's the idea behind what we're trying to do. We're trying to be financially responsible. Controlling costs is essential to business success. That's something that makes sense. And so that's what this is called when we say it's responsibility accounting. Assigning control revenue costs expenses to each manager is responsible. Um, we're working in a merchandise business. We're trying to figure out how much merchandise is coming in now. We want to make sure we keep our costs down. Be the same as if you're working in a service business as well. But merchandise businesses often prepare department review financial statements like we're talking about. We're going to have two expenses, different types of expenses for each of these departments. Our example is grills and furniture. So we have a direct expense, which means is we're going to identify on our financial statement as a direct expense or an expense that is an indirect expense. And so we will clarify and identify these. Okay. An operating expense identifiable with a changeable to the operation specific department is that operational business that's not identifiable with specific departments indirect. We'll show you what that means when we get into that. This is what it kind of talks about. Department manager, this example, has little or no control of the use of electricity in their department, so that would be an indirect expense. The actual cost of supplies would be a direct expense. We'll show you what we mean, and we'll make sure that you don't have too many questions with those. And if you ever have a question with what is an indirect or direct, let me know. Each department's revenue, costs, and merchandise expenses recorded in separate departmental ledger accounts. So we're kind of just trying to make sure you understand. And they have different account numbers down here. It wasn't really relevant terribly to our learning, but we just want you to know that we're going to be doing a departmental margin statement for grills. We're going to be doing one for furniture. That's kind of the idea. We're going to be doing these things. So this should kind of look familiar. We're calling it a department margin statement, but it looks an awful lot like an income statement. Financial statements reporting revenue, costs, and direct expenses. So this is a new spot. Is going to be this responsibility statements. Revenue earned by a department less its cost of merchandise sold is departmental margin. Okay, departmental margin statement is us showing this report. So what do we have in this? We have revenue, which is sales minus the discounts and returns. So you list discounts, returns, add them up, subtract sales, you get a number. That's called net sales. We have cost of merchandise sold, which is the merchandise inventory and the trial balance, the general ledger account at the beginning is probably the best way to look at it. January 1st merchandise inventory. All the purchases, we add up the discounts and returns, and we subtract those to get our net purchases. Same thing as we did with net sales. The contra accounts to sales, sales discounts and returns are added up and subtracted to get our net sales. Purchases has a purchase discount returns. These are contra accounts to purchases. We add those two up, subtract them to get net purchases. Total cost of merchandise available is all the merchandise we had at the beginning plus net purchases gets us that number. All right, less the merchandise on the account at the end of the fiscal period. So we subtract how much we have left over, and this is our cost of merchandise sold. We subtract that from net sales to get our gross profit. Then you add up your direct expenses, advertising, payroll, salary, okay, for this department, and we get direct expenses in 94. We subtract those and we get the departmental margin. That's what we're looking at, okay? It talks about the different sections: operating, merchandise section, direct expense section. So hopefully it makes a little bit of sense. They always make a big deal about this, so I try to make sure we understand where we're getting the information. We're getting this information is obtained from the adjusted trial balance, which we did last section. Format's similar to income statement. We kind of talked about that. Gross profit. Again, I didn't make a big deal about it, but gross profit is here. That's taking our revenue minus our cost of merchandise sold. That's what they're talking about here. Okay. Gross profit shows relationship between sales and sales price, merchandise inventory, and the cost. Okay, we would analyze that a specific way and try to figure out how we can keep our costs down or get our profits back up. And that's why we're doing these problems. All right, how do we get these percentages that you saw on the side? It says up here percentage of net sales. And so we're dividing the departmental margin by net sales to get vertical analysis ratio. That's a lot of words. It used to be component ratio last semester. Okay. Managers use these ratios as guides, percentages. They say it's acceptable or unacceptable. All right. A comparison between components, financial statements. Two of them are financial ratios. Reporting this on a percentage on the same financial statements. Vertical analysis. Later on, it talks about it being the compartment, the ratios that we did last time. Vertical analysis ratios for cost merchandise sold, gross profit, direct expenses, and departmental margin. So you see that. Net sales, cost merchandise sold, gross profit, total direct expenses, and departmental margin. We divide those numbers. So that's what they're telling you we're using. Okay, there'll be spaces for us to fill them out. You won't have to have that memorized. A business may set departmental goals, and that's what you see here. And why these goals are reached or not reached is a variety of different reasons. They can be put into context. There could be different factors, different things going on in that community. There could be different, market trends. There's a lot of different reasons for why something might work or be different from year to year. Products might be out of business, obsolete. There might be a pandemic, whatever. So we have our current ratios. They have last year's prior ratios, the target ratio, and then you can kind of see if it's in that range, then that means we're okay. Okay, if it went down, why did it go down? Is it good that it went down? Is it bad that it went down? You would want profits percentage to go up, I would guess. And so that's good. Expenses you want to keep normal or a little lower. You don't want expenses to go up. So is this us taking a look at the ratios for the current year, comparing them to prior years, and what the industry target ranges are. This is all just talking about how you would try to make changes based upon these different trends and The cost of merchandise ratio, for example, could go up if you made sales higher or purchased merchandise on discount unit price. You can buy things a little cheaper, raise your prices. Okay, none of this is too incredibly earth-shattering. They talk about all the different things, what the department what the managers can possibly be thinking. Vertical analysis down here. This is what I was talking about. Was component percentages last time. So that's what we're looking at. We're going to get these information, and we're going to go through it by figuring out your departmental margin. You're going to get these margins by divided by net sales, and it's very, very similar to our income statement. Thanks.